Welcome everybody to the REI 360 show, episode number 2. My name is Jason Balin. Sitting next to me is Chris Haddon. Have an action-packed show ready for you today. Chris and I are going to discuss for a little bit a few topics related to long-term wealth in real estate investing. You know, all of us are so used to real estate investing and wholesaling properties, flipping it for a quick fee, but there's a lot of really good strategies out there for long-term growth and wealth. Talk about that for a little bit. We also have Josh Weidman in studio today. He's down from Philly. Looking forward to him coming onto the show, chatting with him. And we also have some great questions from some viewers and from the audience as well. So we'll get through those. Again, check us out or answer any questions that you have at the REI 360 show. So let's get going on this. So Chris, as we know, we love real estate. That's what we do. I would say the majority of the stuff that we're involved in is, short-term money related to, buying deals through wholesales or flipping and making a quick buck. But, recently we really you look back and said, what, we don't have, we never really think of real estate investing as long-term wealth and the strategies involved in that. So, both of us, have started to buy rental properties lately, and I think that's kind of a good way to add some stuff to our portfolio.
Yeah, for sure. I mean, us included, we're guilty of this, and definitely our clients and friends in the business. The short-term money's sexy, obviously. You make 10, 20 on a wholesale or 50K plus on a flip. That's very tempting compared to, I'm going to make a few $100 cash flow and I'm going to cash in 20 years. It's going to be awesome. Not nearly as sexy, and understandably so, but that is how the real money is made long-term in real estate. And I mean, if you want to pick between short-term or long-term, our answer is let's do both.
Absolutely.
Let's do both. We have a shorter sort of, timeline when it comes to hard money loans and even our own acquisitions. Our clients do too, but we're really pushing ourselves to buy more and more long-term holds, and we certainly recommend other people do that too. Just picture it down the road, the snowball concept that we talk about all the time, that we wrote about in the book. We'll get into that more on another day, I guess.
Sure.
But real estate is, income-producing real estate for a few different reasons is an amazing snowball.
Yeah, and one of the things that I think we found recently when we started buying rental properties is, there's deals that don't necessarily work as a flip or any other type of creative strategy to make a quick buck. Typically finding deals on MLS is harder, and the margins are a lot less than, direct mail and buying properties from auctions and things like that. But what we've realized is there's deals that are sometimes sitting on MLS that cash flow, and they actually work as a deal. And most investors are overlooking those deals just because they're looking to flip it. They're looking to make a quick buck on it. And I would say in the past we used to overlook those deals too, until recently, where we kind of we're analyzing some projects and we said, what, this deal's been around. The numbers are so and so. I don't see a way to flip this thing for a profit. But that being said, we can take this thing down, throw some sort of get it quickly renovated, throw some long-term debt on it, and actually cash flows at a few $100 a month. So it's almost making something out of nothing. It was an opportunity that really didn't exist, that, hey, let's start following this formula. And we were able to mold a formula and able to, kind of create an investment vehicle.
Yeah, there's a few things that really came together to make that long-term strategy happen for us. One was hooking up with a partner who's able to run that side of things, because of course we're doing loans, we're doing our own business, we're doing REI 360 and tech-related stuff, and whatever else we have going on. So it was just another thing to juggle. So we did hook up with a great partner for that. Our banking situation worked out pretty fortunately after a bunch of work, as
Sure.
even seemingly qualified borrowers or a company doing a commercial loan or whatever, it can still be an arduous process to set up that line of credit or however that bank facility is going to be structured. But we worked through that too. We're going to do the same in Philadelphia right now. We're going to be up there next week for a similar kind of meeting. And there's a lot of different ways to do that. Or, of course, like Josh is going to talk about too, if you don't necessarily need long-term bank debt, a lot of people prefer that. But if you don't, and you're a cash buyer and you're looking to get into real estate, this could apply for that too very well. And we'll get to that with Josh here in just a second. But a few things came together to really make that long-term strategy viable for us. And it's going to be an important part of our business down the road. I know it.
Absolutely. Yeah, so if you're not you're not involved in both sides, definitely take a look at it. They're different ventures. They're a different way to kind of invest in real estate, but it's, behoove you to consider it. So,
not that we hate on the short-term cash.
I love
short-term cash.
I love short-term
awesome.
cash, and every day, I mean, think about it. How many conversations we had, and we say, so what do you want to do today? Make $20,000 on this flip in 2 weeks, or make $250 every month?
Right. Our answer: do both.
Do both. Diversify.
Right.
There's nothing wrong with that. And listen, there's nothing sexy about having a bunch of rental properties right now generating a few bucks here and there. Although a few $100 a month times a lot of rental properties is sexy. Don't get me wrong on that. But it's not getting rich or anything overnight. But what is sexy is waking up, a year, 2 years, 5 years, 10 years, maybe even longer down the road and say, holy crap, I just accumulated all these properties. They've been cash flowing. They've been covering my monthly nut. My debt's getting paid down on it. I have tenants that are paying my mortgage. Sure,
break down the appreciation.
Go for it.
Okay, I'll do that. Yeah, so some of the things that many people do know, I'm sure a lot of people don't, some of the benefits of long-term buy and hold income real estate. One, like you said, is cash flow today. Like if your rental income on whatever piece of property it may be is more than what you owe on it, your mortgage payment, taxes, insurance, other things that pop up, if there's condo fees, if there's maintenance, add all that into what it's costing you per year and you get more in rent, positive cash flow. Nothing wrong with that. Equity built over time. Of course, this thing is going to appreciate with enough time, 5% a year or something like that. That'll vary, and we'll get into like what affects that too. Also, equity today, like in Josh's model or in ours, like we're buying with a certain percentage of equity built in. Again, not that sexy today, but it's there for down the road. Tax advantages too. We're not giving any tax advice, of course. Our disclaimer, we got to throw that in, right? We're not giving any kind of tax or legal advice, of course, and consult your CPA. But from what I understand is you can depreciate your rental properties and make for a pretty nice write-off on income real estate. There's other things that go into that, like income limits and are you a real estate professional or not. But again, talk to your CPA. But I hear there's depreciation in real estate. It's a good thing.
That's what they say.
Yeah. So those three things considered, it's cash flowing, it's appreciating, it's like a savings account that's growing at like a solid rate. Plus, it's going to take away from what you have to pay in taxes. I mean,
yeah. And in a few years, based on how much money you're paying towards your principal, it's free and clear, just like that.
Free and clear.
So
yeah.
Obviously it's a no-brainer. That along with a lot of other types of real estate strategies works. Let's do this. Let's get Josh up in here.
Let's bring Josh in.
We saved this nice orange seat. You got to change up your little this thing right here. I don't know what they call it. Little wind stream on your mic if you got it. What's up, man?
What's going on?
Did I drop my thing?
Josh,
sound okay?
Josh in the house.
Did I get excited and knock it off?
I found it.
Got it.
All right.
Man, first day on the job, he's already fixing problems.
Holy cow.
We're professional video people, as you can see.
Big time.
So did you hear anything we were talking about?
Oh, yeah.
I know a lot of it relates. Oh, you were? Okay, cool. I know a lot of it relates to you. So, so for those of you, most of you already know who Josh is. We have a lot of different ventures set up with Josh through REI 360, through some management stuff, through some rental properties and some other flips that we're all three of us are involved in. But I'm going to let you talk about kind of your most recent focus related to Turnkey Philly, which is a really, really sexy model. And, I see that type of vehicle popping up in a lot of different markets, actually.
Well, and there's a reason for that. It's because the market is, the financial markets are up and down. They're all over the place.
Sure.
There's really no consistency since the collapse of, in 2008, and everybody's kind of uncertain of where their portfolio is going to go, if they can retire, things like that. And real estate, it's bricks and mortar. It's it's tangible. It's got innate value. Everybody needs a place to live. Everybody needs food on the table. And
everyone understands what it is.
Exactly. It's simple. It's a house.
An option.
Exactly.
People understand what a house is.
Exactly.
Or a building.
Yeah. Sure. Exactly. So I mean, it's very tangible. It's easy to explain, as you said, and it keeps its value. Even when the market goes up and down and up and down. I mean, we've recovered almost completely to the huge losses in 2007, 2008.
Yeah.
And really, the people that held on to their properties, they didn't lose anything. It was a long-term cash flowing investment. The value returned, and really the principal was paid down.
Yeah, we saw that locally here in Maryland, Virginia, and Washington, D.C., where we're based out of. Because some of those areas hit so hard. Some of the D.C. markets, they just got killed. And especially in like Northern Virginia, for example, and you take a property that was worth whatever, $500,000, and that thing went all the way down to like $300,000. And, you know, there was pretty much, if you're a homeowner and you weren't looking to sell the property at the time and you're living in it, it didn't really affect you.
Yeah.
You know, you know, equity was, it's kind of a fake.
Or if it cash flows.
Yeah, exactly.
It doesn't affect you
it's
either.
kind of a fake high in the sky number. But the people that got affected were the ones that either owned the properties and they needed to sell because they couldn't sell them because they couldn't get anyone to get financing for them, or it was very difficult to. Or the ones who maybe were real estate investors that needed to throw a tenant in there, or they need to kind of weather the storm and they had to throw long-term debt in it, and banks were like, I'm not lending on that thing. Yeah. So they got killed, but you look back and then where we are today.
Like my Federal Hill place.
Exactly.
The first place I bought in Federal Hill, Baltimore was, it had some equity and I purchased it, it cash flowed, and then that value dropped significantly. It was upside down, but it still cash flowed.
Yeah.
Exactly.
So I wrote it out, and now it's back to where it was, and we're fine.
Exactly.
Right?
Yeah, I mean, these properties, they're worth more now than they were.
Yeah.
And I'm not claiming that that's always going to be the case, but the fact
You never
is, as it didn't really affect, as long as you had debt in place at the time with it, it didn't really affect you all that much.
Exactly. If you were in it for the long haul, there was really no impact. There was really no risk in having that property.
Exactly.
So the turnkey Philly model is this. I mean, I've seen through the property management company, I've seen a lot of investors be really successful, but also a lot of investors just fail miserably, and have had a chance to look and get an idea of what are the contributing factors, right? So all these things came into play. I mean, the neighborhoods that they were in, obviously, it looks really sexy on paper sometimes to make a ton of money on these cheap properties. But what ends up happening is if there's a lot of crime or things like that, you end up with tenants that continually turn over. You have, construction on the properties. If you don't anticipate expenses, like, hey, the heater's 15 years old, yeah, you could probably replace a couple parts and buy another year or two. But if you anticipate that expense up front, you finance it over 20 or 30 years, and it's a few dollars a month, as opposed to eating your cash flow for an entire year when you have to replace it mid rent. So we took all these factors and kind of put them together. So finding discounted properties, doing construction on the properties, making sure that they're in tip-top shape, they're attractive to tenants, but also they are minimizing long-term maintenance costs. And then pair that with leasing the properties and putting the right tenants in there, attracting the right people, and then property management. And it becomes...
That's why it's turnkey.
That's right, exactly. It's turnkey.
It's because the end client, the buyer, your clients, don't have to do anything.
That's exactly
you have
right.
everything set up.
So you go in, you find the property for them, you do the renovations for them, after renovation, you lease them out, you manage them, and then they come in. I mean, obviously, it doesn't work for everybody because
of course not.
You don't have that infrastructure.
Well, as a business model, it doesn't work for everybody because you don't have that infrastructure. You don't have all those separate departments.
Can't do all that stuff. Yeah.
But as somebody who wants to invest in a deal, they still have to have some qualifications because they got to get end game financing, bank financing, and that's tough. I mean, even with good credit, good balance sheets, it's still hard to get that. But these days, I don't know about your opinion from what you're seeing, but from what we're seeing, it's lightened up a little bit. So and that probably helps the business a lot because you can have more people that fit into this model because they can get back end financing.
Exactly.
I mean, obviously, in a perfect world, you'd love to just have cash people to just buy these in cash from you.
Either one, right?
Yeah.
But either way.
Well, and we do have people on all ends of the spectrum. I mean, a lot of our newer clients, because the lending guidelines have eased up a little bit, they've been able to, it's expanded the amount of people that can get that long-term takeout financing. And so we have a lot more people that are coming in and refinancing and taking most of their money out of the property after the construction, where they're only having to put down 25% on this property and are able to see 10, 15, 18% returns on that investment.
Okay.
Yeah.
So you mentioned some percentage returns. Walk us through, if you could, a recent transaction.
Sure. And
the dollars that went into it for purchase, for construction, for rent, all of that. Walk us through the numbers.
That's great. I wish I had a cheat sheet in front of me. So, excuse me, it's going to be off the cuff.
Yeah.
Okay, so there's a duplex that we just settled on 2 weeks ago. Okay. It's 2-unit building, top and bottom. There's a 2-bedroom apartment upstairs. And when we purchased the property, the seller had it set up as a 3-unit building. It wasn't legally zoned. Okay. So the basement was finished. So the first floor unit ends up being a 1-bedroom with a huge finished basement. It's a really nice space. Okay. The acquisition cost was $85,000. There were $30,000 in construction. So what is that? A 120? Is that is that right? Something like that. Okay.
125?
115. There we go.
On the spot.
Thank God for calculators.
Yeah, exactly. So 115. Now there's so each of the units, the total rent roll I think we anticipated was $1,600, something like that, $1,600 a month. And then once we backed out all of the expenses, stuff like permits, you got to get a rental license in Philadelphia for each unit, so that's $100 a year. Taxes, property taxes on the property, maintenance costs. We figure that even though we do everything we can to make sure that there's no maintenance expenses, things come up. So you got to anticipate it. Leasing fees, vacancies, property management, all of the stuff they're real expenses. I mean, a lot of times I'm sure you've gotten brochures like this from people where they're like, flips are a great example. They're like, acquisition, $50,000. Renovations $50,000 and 125, and you're going to make $25,000 on the thing.
So whoa, what about all the costs?
Where are all the expenses?
Yeah.
But yeah, I mean,
that always happens.
So you're at 115 plus additional miscellaneous stuff. Call it what? Another 15 grand?
Well, these are not. I'm not saying these are transactional fees. I mean, so yeah, there are some transactional fees that if we offer hard money financing up front, so that can help. But there's closing costs, there's expenses, holding costs,
115, 120. You're looking at if you're just looking gross numbers. If you're in for that kind of purchase price, you're getting $1,600.
Yeah, about $1,600 a month.
Which is an important thing to start at market-wise. Right. You'll get into the important numbers, but just to say how much you have to spend in DC Metro, Jason, to get $1,600 in rent.
Yeah.
Right.
Approximately how much you have to spend? I don't know. In Silver Spring.
Few hundred grand probably.
3 something, right? Yeah. 3 something to get
a few. Yeah, I mean a few $100 grand, but yeah, it's
a few $100 grand.
Exactly. I mean it doesn't.
As opposed to 115.
It doesn't cash flow. I mean it's a different business model. I mean in my opinion at least, a property in Silver Spring like that will probably appreciate a lot more.
Sure.
And you base it off that. Too. So you say, hey, I'm not going to cash flow. Well, I will cash flow and put a ton of money down, but if I want to fully debt it, fully lever it up, I'm not going to cash flow, but it'll probably appreciate over time, and I pay it down. So. It's a similar type of model. It just differs a little bit.
The income's coming, the revenue's coming from.
But Philly's a good market for it, and a lot of areas are.
Yeah,
and Baltimore,
around
here, Baltimore, you can do that in. Yeah. It's just it doesn't work as well in DC.
Yeah. But it doesn't work in every.
It doesn't work in every.
Philadelphia.
And I know, we know some other larger companies that do this on a higher scale, and their model is strategically putting themselves in the markets that work. Their local market does not work in. They base it off. They base it off of different areas of the country that works.
Yeah.
Personally, in my opinion, I don't love that model because I think real estate's a localized business model, and I'm glad you do it in Philadelphia because you're in Philadelphia. It makes sense, but for each their own.
Yeah.
So.
All right. So back it up a sec. Do we finish with the numbers? So how?
Okay.
Yeah. Net figures, equity built in, all that stuff.
The calculations. This isn't a plug, but the rental calculations on the website are what I use, like the rent calculator, to give the bottom line. It's like the net number at the end of the year after all your expenses, and even anticipating stuff like evictions and maintenance, because it's going to happen. It's going to happen sooner or later.
Sure.
It's part of the business.
Sure.
But you should, with these investments, they come back at consistently 10 to 15% cash on cash return. The total money out for the buyer was about $30,000. That was their capital that went into that.
Right.
And so they're getting about I wish I had a calculator.
Round numbers.
Okay, so if they're getting $3,600 a year, that's 12%. They're getting $3,600 a year on their money, and that's just
for their cash out of pocket.
Exactly. That's
cash
just
on cash return.
Exactly.
Wait, is that if they buy the property in cash, or if they put up cash and then have a bank debt?
I'm talking about with a bank debt.
Okay,
it's a leveraged return.
Okay.
And what they get, my favorite part of this, you guys, I'm listening to your conversation about some of the non-transactional benefits of real estate. I love that you can have multiple revenue streams. So you get appreciation in the asset. That's going to happen over time. On a long enough timeline, I mean, every real estate investment is a good deal. Like we've talked about that before, especially in DC. The only people that have rental properties in DC are people that bought them a long time ago. Either that or they don't cash flow.
Right. That's right. Yeah, they just put it, and listen, there's nothing wrong with if you have liquid cash to throw 30-40% down in cash, because if you don't have if you're a passive investor, you're not an active guy hustling every day, throw it in there, let it sit there, chances are it'll appreciate more and get debt for the difference.
Right.
So we're certainly not against that, but this day and age, a lot of folks want to get in with a little amount of money out of pocket.
Right.
I mean, we buy some properties in cash, or we use private funds to get to buy some of our rental properties on the front end. But we're working with those banks to get every stinking dollar back out of those things. I want that liquid cash, and I want that 5.25% interest rate that they're going to give me on long-term debt.
Right, for sure. Well, and that leverage.
My money's more valuable than
exactly
than theirs.
Right.
If you look at it like that.
Not everyone owns a hard money lending company.
Yeah, but I mean, if it's you take that cash and you put it into another deal. There's no point to use your $100,000 and get involved in one deal when you could put 10 times $10,000 and get into 10 deals. Yeah. Especially as all of us are active real estate investors.
Well, and this is one of the keys that I saw when we were, when basically we looked at our investors that owned these properties for the management company. One of the things we saw is that people that were successful and really didn't get hurt when they had, when their portfolio was not bringing in money, were the people that were leveraged, but they weren't over leveraged. They had 25, 30% down, maybe as low as 20, but the monthly cash flow was not, it was enough to cover their nut every single month. Right. And if they had, plus reserves and things like that.
There's cushion even if that rent drops.
There
because
we
in
go.
a down market, the rent can drop.
Yeah.
Everyone, all these people who can't sell their properties throw it on the market. All of a sudden there's tons of inventory and rent goes down.
That's right.
You go from $2,000 to 1,800, then you're like, do you still cash flow?
Exactly.
Hopefully.
Right, exactly. So, but I mean, the leverage is what I love. I love the leverage because not only do you're
laughing at me. Sorry.
No, it's cool. With real estate, you get that leverage gives you much better purchasing power. I mean, it's like you go into, if you go buy some stocks, unless you're a day trader, no bank is going to come out and you say, look, I need a loan for 75% of the value of the stock market. The stock, they're going to look at you like you're crazy. So, basically that's what you're doing. You're going and buying an asset that's worth 3, 4, 5 times the amount of money that you have to put down, and you get to own it.
Absolutely.
And somebody else gets to pay off the principal. And it's a great model. I love it.
Yeah, and I mean, even people that are active real estate investors, they still probably should diversify with even your type of model. Either they do it themselves and they do the heavy lifting. Obviously, if you're going to do all the heavy lifting yourself and you want to be active, you're going to get the highest rate of return. That's just what happens.
Yep.
But there's nothing wrong with having an expert in that particular field to do some of the passive work, like we do with stuff. Some of our stuff, our core business model is active, and then we also have passive ventures as well that we just don't have the time day to day, and we're willing to take a somewhat reduced return for that.
Well, Turnkey,
touch on that for a second. Who are your clients? Who are the people coming to Turnkey Philly to buy properties? What are they like?
Well, they're kind of bipolar. I mean, Turnkey, seriously, they are. We've got them on both sides of the spectrum. It's not so much in the middle. Turnkey Philly is kind of like a mutual fund. It's like, if you're going to go and you're going to be dealing with a broker, and you let him to make the decisions. You're going to give him the money, he's going to invest it, and he's going to give you a return.
Yeah.
That's the idea. If you want to be a day trader, go flip properties.
And active.
That's exactly.
Yeah, it's meant for someone who wants to be involved in real estate in a passive manner.
Exactly.
That's number one, right?
Yes, that's number one. The second thing is our investors, if they are looking at leverage, they have to have at least a 720 credit score. That's the minimum guidelines.
Sure.
But this is why I say they're...
And a lot of them are cash buyers, too.
That's where I was going with it. About half of our investors are cash buyers. They just buy the properties all cash, and they keep their money there. And then the other half are people that they put down, 20, 25%, and they're able to leverage that, and to get a cash flowing investment.
Yeah, it popped up recently when we were at a conference, remember? And someone who's not in real estate at all was commenting on this model we were talking about, just because we were using as an example, discussing something unrelated. And he was like, whoa, so we can invest in real estate in that way without having to be actively involved. Most people aren't into it, because just like the same reason we don't trade stocks.
Right.
It's like we already have something full time we do, and we don't know how to trade stocks. And we don't need to.
The other funny part about that is when you talk about, you're a real estate investor, everyone just assumes that you're buy rental properties. Like people outside of the industry don't even really take flipping houses. Besides, flip this house
People
shows.
know about flippers though.
But I recall them just talking about so I'm going to buy rental properties. Like that's just what they thought the niche what it was. So cool. Well, your model rocks.
I love
How can people contact you? Where can they find you or to learn more about Turnkey Philly?
You can go to our website at turnkeyphilly.com and
Cool.
just call us from there. You can set up a preliminary phone call and kind of see if you qualify. So,
my man,
gentlemen, thank you for having me.
Thanks for coming on.
Appreciate you stopping in.
See you next time.
We'll see you in a few minutes when we're done with the show.
Great.
Cool. So, all right. Well, let's do this. We're going to wrap up the show. As you all know, we take live questions at the REI 360 show. Any social media network you're on. Our producer gave us a few that came in. I'm encouraging you to send us as many as you have. We're here. Utilize us as a resource. So this is what we got. Let's see here. How do you guys pick the areas that you purchase, where you purchase your properties in? Good question. So, good question and easy answer. The easy answer is in our local market. At least that's
that's first.
At least that's what we do. We're believers that real estate's a localized business model. I mean, we're active real estate investors. We want to see, touch, smell the actual real estate. We like to go down there and see it. So
that's
for
number one.
For number one,
it's near home.
Like we like to do it near home. Can you invest out of state? Sure. I mean, as long as you have. I mean, we don't personally recommend it because we like to be active with our collateral and our investments. But if you want to be a passive investor and you have a trustworthy boots on the ground provider that's going to be operating, an operator, not a provider, an operator on the ground that's going to be able to take care of it, sure. Let them do it. But you got to have trust that they know what they're doing and they know, and at least they know that area.
Of course, of course.
So that's our opinion.
Buy near home.
Buy near home. Doesn't matter if it's a flip, rental property, whatever. I would consider buy near home, especially if you're new to real estate, because you can at least go touch it and you can kind of see what you're getting involved in.
And you could go more and more in depth. You could go on that one for a long time.
Agreed.
Where you buy and rental rates or appreciation or all kinds of stuff. But I mean,
and get comfortable.
That's a good place to start if you do. Is like buy close.
And do something you're comfortable with. If you're comfortable with rental properties because you had a property before and you turned into an old rental property, you're comfortable with it, do it that way. If you're comfortable with flips, do a flip. Whatever you're comfortable with, stick to until you start ramping up. All right, I think we got time. One more question.
We'll do one more.
Let's do one more.
Remember, you can submit questions anywhere, Instagram, Twitter, Facebook, using the hashtag #TheREI360Show.
Yep.
Hashtag #TheREI360Show. Submit any question you want for next time. We're going to do one more.
Okay, so I just graduated college, and I'm not sure if I should go get a job, a job, or should I try to start my own business, which I'm interested in. I mean, this could be a whole topic of a show.
Oh, that could be that could be a book.
But yeah, you want to tackle that? You want to start tackling that one?
Sure. Well, a couple things there. I mean, without really getting into whether you're meant to run a business, whether you have that entrepreneur, mentality, personality, that drive, everything else. Let's just assume that you do. Yeah.
Fair enough.
Should you or should you not do that immediately out of college? It's a tough one. I'm going to go with figure out the kind of industry you want to be in and work some kind of salary job, some kind of W-2 job. Learn the ropes, figure out if that industry really is what you thought it was. Learn just the technical stuff, what you need. Do like a 2, 3, 5 year run maybe. A lot of people who we know who are running successful businesses now did do that for a while. Some people did.
Including ourselves.
We did.
I mean, we were in the industry and we loved it.
Riegler did.
Yeah.
Like really learn the nuts and bolts of your industry and then go out on your own. Plenty of people did that.
I mean,
some people would disagree. Some like real certain hardline entrepreneurs will say that they can never have that job to begin with. So Well, it depends on who you are. Depends on your maturity level. I mean, some people. I mean, Zuckerberg. A lot of people peaked at like 16. At 15, 16 years old, and he was a rock star, and he was like, there's got to be a better way type of slogan, and he was able to do that at 15. At 15, that wasn't us. So it just depends. It just depends on who you are at any given time. If you're in college and you have some sort of whatever. I mean, these days, entrepreneurship. Is that the word? Or entrepreneurship. Entrepreneurship.
With an R, okay. So, that's common in college. We didn't really have that in college. So you can kind of get your feet
Not as
wet
much.
with some of those things to determine if you really want to do your own things. I mean, some people are scared to death of starting their own business, and they think it's safer to have a W-2 job. I would disagree, but that's just...
That's another topic, too.
That's another conversation. That's another topic, too.
Yeah, short answer is get a job, learn the ropes, and plan your move.
Yeah. So, cool. Hopefully that answers all your questions. Again, check out at the REI360show.com. We are open to, no question that scares us. Anything related to real estate, business.
If we don't like it, we just won't answer.
Anything business, real estate, marketing, and more. Hashtag the REI360 show. Check us out.
Episode 2.
And see you on our next episode.